The bank just offered to bump up your credit limit. Obviously, you should take it, right? There's some pros and cons to that, and we're going to debate them starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
When I ask my clients, what happened? How did you get into so much debt? They tell me that the credit card company offered them a credit limit increase on their credit card, so they took it. Or they called me and offered a line of credit, so I took it. Makes sense. If someone offers you something, you take it, right? But is it always a good idea? What should you watch out for? So today on Debt Free in 30, I've invited back Diane Cunha. Did I pronounce your name correctly there?
You did.
Oh, I nailed it. Who was with us back on show 235 when we talked about credit cards. Today we'll have a discussion about the pros and cons of pre-approved credit limit increases and lines of credit. I'm going to explain why conventional wisdom says they're a good idea, and Diane will explain why the conventional wisdom is often wrong. Diane, ready to go?
Let's go.
Okay, let's do it. So, reason number one, this is pretty obvious actually, why you should accept a credit limit increase on your credit card or line of credit is there's no downside. Why would you say no to someone offering to give you a higher credit limit?
Well, usually when you are pre-approved for a product, doesn't necessarily mean that you'll get it. So pre-approval is based on your habits, essentially, to see, okay, have you been paying off your debts on time, minimum payments? Do you have a lot available, a lot of credit available? So yeah, they'll say, you know what, you're pre-approved for this. The issue is that they might do a hard credit check. So it doesn't necessarily mean that you're automatically approved. They say, well, you know what, come in, let's do the application. All right, we did the application and you're doing a hard credit check, which does hurt your credit in the end.
So saying you're pre-approved doesn't mean you're pre-approved.
Correct.
So are you saying a bank would actually lie to someone? I'm stunned that you would say that on this show here.
It happens.
It happens.
The thing is that they don't take a loss out of that, right? So they get you in. It's all about money. So yeah, you know what? You're pre-approved for $14,000, $15,000. They get you in, and let's say you do qualify for it and you say yes, well, it's no loss on them. It's a win-win for them because they do end up making money off of you once you start using it.
So I get this form in the mail, says I've been pre-approved. I actually fill out the form. I send it in and it turns out, oh, guess what? Actually, no, we've now done a full credit check on you instead of just the soft hit that we did to generate this form. And you don't qualify. Oh, too bad. Now you got a hard hit showing up. Okay, exactly. So I'm stunned that banks would do something like that. That's just amazing. I hope you're lying to me and that's not actually true. So now, I mean, frankly, if they are offering this pre-approved deal, I think there's a pretty good chance you will actually be pre-approved. So right. I agree. Okay, maybe they haven't done a complete, workup on you, but they've done a soft hit. They know that you're, good enough to qualify. There's probably not a whole lot more they're going to find out from you when you actually fill out the form and apply for it.
Right.
So again, it's not costing me anything to say yes to the higher credit limit.
Right.
So why not just take it?
So the banks know that on average, people will end up using that higher credit limit. On average, people will say, you know what, I'll take it just because it's there. It's based on, a lot of things are based on willpower. So when I see clients and I say, okay, this is how you rebuild your credit, and they say, well, I don't want a large credit limit. It's like, great, you know yourself better. Maybe some people who have a higher credit limit, yes, they understand that if I use it all, then I'm going to be paying more. There's no temptation there. But on average, people are more likely to use it, which in the end makes the bank money.
But I don't have to use it.
Right.
So
you don't have to.
So again, I mean, just take it. Okay. And what you're saying is you got to be disciplined.
Correct.
So if I'm disciplined, okay, I'll just take it and run with it and everything will be fine.
Well, not necessarily. I mean, again, when you're offered large amounts of lines of credits, you have a good credit score. I mean, when people come in, they say the majority of people say, you know what, I don't have a bad credit. I don't have a bad credit score. Honestly, everything is great. It's like, well, yeah, of course it is, because you don't get credit with bad credit score. So for you to get more credit doesn't make sense. If your credit score is great, why get more credit?
Wow.
Why
So
fix that?
let's talk about credit scores then.
Okay.
Because you and I have had this discussion many times.
Mm-hmm.
Your job here at Hoyes Michaelis, and we're in the Kitchener office, which is our head office where our fancy studio is here, and you meet with clients just on the other side of the wall there all the time, right?
Mm-hmm.
And so people come in, and it's a very common thing to say to you what you just said, that, okay, I know I got debt, and I would like to rebuild. I'd like, don't want my credit score to be hurt. I want to improve my credit score so I can borrow more money. So would it not therefore be logical, if the bank is offering me an increase in my credit limit or a new line of credit, I should take it, because that will lead to a higher credit score? Isn't that exactly what people want and need and should do?
I think that people forget that, you know what, your credit score is great, offering you more. Wow, this is great. This is flattering. I can get more.
Mm-hmm.
I can use more. But remember, whatever you use, you have to pay back. So, I mean, when I see people come in and, they say, I have lines of credits here, and they're all maxed out. Well, yeah, the bank is offering you more because, one, you're paying on time, you're paying the minimum, which is interest, which is a lot of money that you're making them. So why not offer you more? Because maybe you can afford more. Let's try to get more money out of you. So, I mean, to increase your credit, if your credit's good, why have it any higher? If you're at, people come in here 750, 800, great. Why do you want it any higher than that? What's the point of having that? I mean, would you rather have a high credit limit or no debt?
And so your big worry is, I focus on the credit score, and that leads to higher debt, which ultimately leads to a lower credit score because I get myself into trouble.
Yeah, because if you think about it, a credit report basically tells creditors, how well do you manage your debt? How much debt do you have? Do you pay your debt on time? Have you accumulated more debt down the road? So, and that score, it gets generated, the FICO score, a lot of people know, the higher, the better. Is it worth it to you, though, to have such a high score and have debt?
Yeah, but, and again, I'm giving the counter arguments here.
Mm-hmm.
My credit score is based on what you just said, debt and everything, but it's also based on utilization.
Correct.
So the best credit score, and you and I don't know the secret formula because they don't tell us what it is.
Right.
But our best guess, based on the, tens of thousands of people literally that you and I have met with over the years, is that your credit score is higher if your utilization is at an appropriate level. So utilization is the percentage, as you know, of my total debt that I'm actually borrowing. So if I've got a $10,000 credit limit on my credit card and I carry a balance of $2,000, that's a 20% utilization.
Right.
So 20%, that's pretty good. That's what the banks like to see. That makes your credit score higher. If you're utilizing 100%, they figure you're pushing to the limit,
mm-hmm.
and therefore are at high risk of default. So that's not good. But if you have a 0% utilization, well, you're not much of a customer then, because we can't make any money off you. So the conventional wisdom is you want to try for 20, 30% utilization, so that's just enough. Well, if I get a credit limit increase to $20,000, then the $6,000 I'm borrowing on my formerly $10,000 credit card is no longer 60% utilization. Well, now it's 30% utilization or whatever. So is it not better then to get as much credit capacity as you can, which will then lower your utilization and therefore make your credit score better? See, I've got it all figured out. There's no way you can respond to that. I think I've won this argument then.
But the thing is that it still reports the credit that you use. So when you see high credit limit and, how much you've used there in regards to, like, say, the 6,000 into 20, are you 100% sure you're not going to use more than that 6,000? Again, it's based on the banks know on average, if we offer this to you and we put aside the whole, even if they say to you, yeah, use it for emergencies. What if you lose your job? What if this happens? Well, you still have to pay that money back. It's always better to rely on your own money, on cash, rather than having this huge limit. Especially, like I said, willpower is the biggest key here. And banks know that people will resort to credit to avoid losing their house, to avoid losing their home, like renting, to help their kids, Christmas, anything like that. They will resort to that.
Okay, so you've hit on a couple of issues here.
Mm-hmm.
So we are recording this. It's May 2019. And so for people who are watching this in the future, I can tell you that as of today, the economy is still doing pretty good.
Yep.
Unemployment rate is pretty low. Interest rates, well, they ticked up a bit over the last year and a half, 2 years, but they're still very close to historical lows. Times are good.
Mm-hmm.
And we know that when times are good, banks want to lend lots of money. And then when times get tough, they cramp it all back and start, reducing your lines of credit and canceling lines of credit and calling back credit cards and things like that. So does it not make sense when times are good, as they are now, to get as much credit as you can? You don't have to use it, but are you not better off getting it now while times are good? Because when times get tough, the banks aren't going to give you any new credit.
Mm-hmm.
So at least if you've got it locked in now, then you've got it if you need it, if times get tough in the future. So get it now while the getting is good.
That is a very dangerous statement. So I'll use an example of a client that I saw recently that she went off sick 10 years ago, went on long-term disability, which doesn't pay very much. It pays something, but not enough to maintain a household of 5. Her husband's working, and she has lines of credits. So the banks offer this to you. Perfect. She got the line of credit. She was utilizing it. She waited until she got an insurance paid out. Perfect. Paid off that line of credit with that insurance payout. 4 years later, has debt again. Came to see me and is like, I don't know what to do. I don't want to lose my house. What did that do in the long run? It put a Band-Aid on the issue. It didn't help her whatsoever. I mean, it's the lines of credit. It's the idea of I have to pay this back, or I have debt, but I'll deal with it in the future. Well, now the banks are coming after her and saying, we want $5,000 today. We're closing this line of credit today. We want this money now. How is she going to come up with this money? She doesn't have it. So getting a product because, you know what, in the future, I might need this. Well, no, use your own money for emergencies, because in this situation, she's already paid tens of thousands of dollars in interest to avoid a problem that was going to happen. So the line of credit didn't essentially help her in the end.
So you're saying, what the bank giveth, the bank may taketh away.
That's right.
To quote.
That's right. And now that she has all this massive debt load, her debt to income ratio is not good, meaning that she has more debt than what the household even takes home, that when she needs a car, she's not going to get one, because they're going to see, holy smokes, you got all this debt over here. How the heck could you afford a car payment of $500 a month when you need to pay $2,000 a month on all this other debt minimum?
So getting the credit up front when you didn't need it ended up meaning she couldn't get it when she did need it in the example you're giving.
Well, and she couldn't get more help. I mean, it just dug a deeper hole for her, because she used it, she had it, was great, increased the limit. Okay, I'll worry about it later. But now it's in demand. So they say, no, we want this $50,000 now. Well, how is she going to pay it? Because she doesn't have enough income. So it did not help her in the end. In hindsight, it did not help her. And I think that's what people mistakenly use lines of credits for. It's, you know what, this is temporary, it's temporary. Well, unfortunately, we don't know how long that's going to be.
Yeah. If you get it, how can you pay it back?
Exactly.
Okay. I'm willing to buy that.
Okay.
I think.
All right.
Again, it all comes back to what you were saying before about discipline. If I'm disciplined enough, I can borrow it and pay it back, then I'm good. But if something happens once I've borrowed it, now I'm in even more debt than I was in before.
Right.
Okay, so let me throw another thing at you then.
Okay.
Every financial guru out there says that you need to have an emergency fund. This is like the basis for all financial planning. So set aside 10% of your income, and it should be in a savings account, a TFSA, something, so that if something goes wrong, you get laid off, you lose your job, whatever, there's money sitting there. Okay, you can't really argue with that.
Right.
But here's the counter argument to that. So let's say I've got $10,000, I've saved up $10,000. And I put it in a savings account. And you know how much interest I'm earning on that savings account? Pretty close to Zippo. Okay, so even if I'm some really sophisticated investor and know how to get GICs or money market funds or something, I'm like not making any money at all. So would I not be better off? And I understand if I lose my job or something and I need some money to pay the rent, then I need access to money. But I don't need access to savings. I need access to money. So why not have a line of credit sitting there, a $10,000 line of credit that I haven't used, And then if I do lose my job, no problem, I can draw on that money. And so instead of having $10,000 sitting in a savings account earning me nothing, if I actually do have savings, well, why don't I invest it in the stock market, buy some mutual funds? Stock market always goes up, right? Nothing can go wrong with that. Or maybe I pay down my mortgage on my house or invest it in real estate or something. There is probably something I can find to invest that $10,000 in that will earn me more than the 0% I'm going to earn at the bank. But I need an emergency fund. Great. I will have a line of credit as my emergency fund. Bingo, boongo. There's a perfect reason to have a line of credit.
So you said savings is 0%. Is line of credit 0%? Because line of credit is not.
Well, but I'm not actually using the line of credit. It's just sitting there if I need it, which is exactly what's happening with the savings. It's just sitting there if I need it.
Right. So if you choose to use line of credit, there's going to be interest. Right off the bat, you're paying the bank interest. You're worrying about minimum payments. When I sit down with people, they say, you know what, I can't save money with all this debt. It's like, well, you can't save when you have debt because all of your money is going towards debt. So why wouldn't you deplete the savings that's at 0%? Isn't it better to deplete that rather than to worry about a line of credit that is costly in the end? It's going to cost you more money to use line of credit rather than to use your savings because, your savings, the interest rate, the savings rate is like 0.2% or something. Yeah. But at the end of the day, it's your money. It's not someone else's. And I think that's the biggest key. It's that illusion that if I use this line of credit, I'll pay it back. Don't worry about it. Well, now you got a minimum payment of $200, $300, $400. It's going to increase. And then when you can't pay it back, well, guess what? They're not going to help you. You're too risky. Now what? You lose that 10 grand anyway, and then you're back at square one. You're in a hole. So it
comes down to risk, is what you're saying.
Huge risk, yeah.
And I get it. If I put my $10,000 in the stock market, there is a chance that it will not be $10,000. It might go up, but it might also go down.
Yeah.
So you're saying, well, maybe I'm better off earning 0% on a savings account or 0.2%, but it's actually my money. Nothing can go wrong. There's no risk. Right. So okay, I'm not done yet. I got more on my cue cards here. Here is an actual comment I saw on Reddit, which is something on the internet where people talk back and forth. I get mentioned every now and then. So does this podcast. So thank you to all you Reddit people. And this was referring to lines of credit. Okay. And their comment was, it's a super premium payday loan. So okay, instead of getting a payday loan, which has a super high interest rate, why not have a line of credit that has a very much lower interest rate? Makes sense, right? No downside there?
Well, debt is debt in the end. So once you yes, it's lower interest, 6, 7, 8% rather than
390%.
Yeah, 400%. But again, it will slowly grow, and you have to pay it back in the end. So
what's better, a line of credit or a cash advance on a credit card, a payday loan, an overdraft? Like, I would think the line of credit is better than all of those because the interest rate is less.
It would be, but let's say you have one of each of those products and you put it on your line of credit. And can you pay that off? What's the interest rate? Yes, it's lower, but then I rarely see people that just use a line of credit just for emergencies. I mean, they end up, I'll pay it later. It's this mentality of when I have the money, I'm going to pay it. But something always seems to come up. So
tell me a story then. So again, you are a credit counselor here. Mm-hmm. So you're meeting with many, many people every day, either before they filed their bankruptcy or their consumer proposal or afterwards. Because in every bankruptcy or consumer proposal, there are 2 credit counseling sessions where they meet with you and you go over things like exactly what we're talking about here.
Exactly.
The use of debt and budgeting and credit repair and all those sorts of things. So can you think of a client or two that you have dealt with in the recent past who had, a bunch of credit card debt, a bunch of line of credit debt, who sort of got it thinking that, I'll be able to pay it all off and it'll all be good, but ended up coming back having to file a proposal because they had no other choice?
Yeah, I seen a couple recently that everything was going great. They thought It took them a long time to come in, because I tell people when they come in and see me or go into any one of our offices, the hardest thing in this whole process is calling us and showing up for the appointment. Because a lot of people feel embarrassed. Nobody says, I want to grow up and file for bankruptcy. That doesn't happen.
That's true.
So it's a tough process. That's the only toughest thing to do, is just to come in. Once you show up, so I saw this couple, and I'm writing down all their debts, and they have $200,000 worth of unsecured debt. So that is credit cards, lines of credits attached to nothing. And they have been paying this for 20 years constantly. And the way he was doing it was he was having his paycheck. So the husband was depositing his paycheck into the line of credit. So constantly the minimum payment was being made. But then he was using a line of credit to pay the other guys. The most common phrase, robbing Peter to pay Paul. So he's paying off this guy, this guy, this guy, this guy. And he goes, we can't do it anymore. Now the minimum payment's going to get too high that his paycheck's not going to cover it. Now what? Well, filing consumer proposal was the first time that they had money. After a month, they said, wow, we were able to buy winter tires with our money, not borrowed money. And that was a situation where the line of credit increased. They had a home, then they sold the house, but they never took away the line of credit. So they kept offering more, and they took more because they needed it to live. They needed it for whatever. And they thought, you know what, we'll worry about this later. And they got to the point where they said, you know what, I wish I did this years ago, because it was just so much easier to file a proposal than to constantly pay down this debt. I mean, I told them 20 years worth of payments, you've probably paid your original purchase 2 times over.
Yeah, maybe 4 times.
Maybe, yeah.
And the example you give of someone using their line of credit as their bank account, that's not unusual. I mean, $200,000 worth of debt, okay, that's higher than the typical person we're dealing with. The average person we see, it's sort of like $40,000, $50,000, $60,000, and some are smaller, some are larger. But yeah, using your line of credit as a bank account makes perfect sense. I don't have to pay banking fees. There's no bank fees on a line of credit. I can put deposits in. It lets me write checks against it. So look, I figured out a way to save on banking fees. But you're right, the interest on $200,000 over a 20-year period is, easily $500,000 or whatever it was they've been making in payments. So, okay, we're running up against the clock here. So let's get the practical advice. And I'm going to start.
All right, go ahead.
I'm going to start.
Go.
I am going to tell you a couple of times where it may actually make sense to say yes to a credit limit increase on an existing credit card. So we're talking credit cards. We'll talk about lines of credit in a minute. The first one would be if I am constantly bumping up against my limit. So, for example, I have a credit card. It's got a $1,000 limit on it, and I use it for business purposes. I'm a sales guy. I travel a lot. I'm putting hotels on it, and I'm always bumping up against my credit limit, and they start whacking me with fees, over limit fees and whatnot. So in that case, okay, bumping your credit limit up from $1,000 to $5,000 or whatever means I don't get hit with those extra fees. That, to me, makes perfect sense. The other obvious example would be instead of using a debit card for everything, which is frankly what I recommend because you're using your own money. But if I use a credit card, then I'm earning points. Maybe I can get some advantage by doing that. So there's a couple of obvious reasons where it does make sense to use a credit card. Now,
can I get back to this reward thing?
Sure.
So the issue with rewards, though, so if you're paying, let's say you have a credit card, a travel card from the bank, $5,000, and you did this increase, you're paying for those rewards, and you're paying more than what the rewards are even worth. So in the end, it is a good thing for that, but I think people need to remember that huge fact because I tell people all the time, you have to make the credit card work for you, not the other way around.
Yeah, if I'm paying it in full at the end of every month, then great. The rewards make sense. The over limit fees I've eliminated.
Right.
But I mean, the point you've continually stressed through the last 25 minutes has been, but if you don't end up paying it, then you've got a problem. So okay, over to you then. Give me your list of when you should say no, when it is a bad idea to get a credit limit increase on your credit card.
So a bad idea would be if you're starting to use it for living costs. So for example, it's like, okay, I really need to pay this hydro bill. I really need to pay this utility bill. So you're using the credit in order to pay it because you don't have your own money. So there's a red flag right there. People, I think, again, have this mentality of I'll worry about it later or it's not that much it's not that much of an payment. I will be able to fix this. Well, once it gets too high, it's too high. But living costs are a huge thing, which leads to having an unbalanced budget. When you are paying too much for one thing, well, what's going on within your budget? When I sit down with people, I say to them, it's not my job to sit here and tell you, you need to cut this out, this out, this out. It's like, okay, what works for you? Because if you want to keep something in your budget, you have to either bring more money in or take something out.
It's math.
It's very simple. However, it's not a simple decision of what you want to do, but it's not my job to tell you, you can't have, $200 of the cable. I mean, that's kind of silly, but at the end of the day, if that's your thing, that's okay. It's just, how are you going to make that work? Well, if you're using your credit card because you really need that, well, that's not a good idea. I talked about willpower as well.
Mm-hmm.
So everyone I sit down with, when we discuss this is how you rebuild credit, the first session we talk about, let's talk about saving money. Where's your budget at? We'll review the budget again because many clients are, how do I rebuild my credit again? That's not your concern. Your concern is saving your money first, and then we'll talk about rebuilding credit. When I see them again in 4 months, we talk about rebuilding credit. A lot of them just saying, you know what? I don't think I'm ready. Good. Then don't get it. You know yourself better. I can tell you, use this card for gas. If you have an accessible amount and you think you're going to use it, then don't get it. You don't have to do anything you don't want to do.
You have to know yourself then. So, okay, we've talked about a credit limit increase on your credit card. Mm-hmm. So now let's talk about getting a line of credit. So again, I've got a nice list here of why it's a good idea to mm-hmm. get a line of credit or to increase the line of credit that you've got. I mean, the obvious one is they've got lower interest rates. Mm-hmm. So if I'm carrying a balance on a credit card at 19.9%, but the bank is willing to give me a line of credit at 5%, kind of a no-brainer, transfer one to the other. I'm going to save myself some interest. We already talked about, money in a savings account. Well, you're probably better off having a line of credit as your emergency savings plan, right? That makes perfect sense. If I'm going to be spending the money anyways on things like financing renovations or whatever, then again, kind of makes sense to have a line of credit to do that. Perhaps you do lower your utilization by having a higher available credit, and that maybe makes your credit score better. And so long as you're responsible, there's no problem. And it might be something you need in the future, so why not get it now so you've got it? Those are the arguments in favor.
Okay. Tell
me why you think there are some problems with jacking up your available credit on a line of credit.
So the first most obvious is you have to pay it back. Mm-hmm. You are obligated to pay that back. You signed a contract. Mind you, we can help with that if there was an issue, but you're saying, I'm going to pay whatever I use, I'm going to pay it back. And like people that we see, they want to pay it back. They say it's morally wrong if I cannot pay this back. But that is the biggest point. Second is cash is always better than having debt. So having that $10,000 savings, I'd rather have $10,000 in my savings mm-hmm. than $10,000 worth of debt. So you decide what is better. It's always to have accessible cash is always better than accumulating debt and having interest when you don't have to have the interest. I mean, like I said, to save money, you can't have any debt. So if you have money saved, wonderful, then you should not have any debt because that should be used instead of your lines of credits.
And so really what you're saying is you've got to know yourself.
Yes.
There is this illusion of security that, I've got all this available credit, so I'm going to be fine. Mm-hmm. When in fact, no, what you really have is access to a whole lot of debt. And that's just a big worry.
Right.
So to sum it all up, you're kind of siding on the angle of, the less debt is better.
Yeah. So when an emergency, rely on yourself.
Rely on yourself. Excellent. Well, that's a great way to end it. Diane, thanks very much.
Thank you.
So that's Diane Cunha, who is a credit counselor here at Hoyes Michaelis in Kitchener. So if you would like to sit down and have her explain all this to you, then you can track her down through hoyes.com and do that. Now, obviously, on today's show, I presented arguments in favor of bumping up credit limits and credit card lines of credit. But, obviously, I'm kind of on Diane's side on this because I see the impacts of having too much debt. Mm-hmm. Debt is dangerous. And unless you're very disciplined, having access to debt can cause trouble. And I think you made the comment, and of course you were quoting from my book here, Straight Talk on Your Money. I don't think we got the commercial in yet.
No,
so
gotta get that in.
Got to refer to it every day, every time we do a show. Myth number 4, give credit where credit is due. This is my favorite myth. And the reason is the banks call it credit, but really what it is debt. Mm-hmm. And so even though they've increased your credit limit on your credit line or your credit card, really what they've done is increased your debt limit on your debt line, on your debt card.
Exactly.
And if we think of it that way, then that probably makes it a lot easier to say, nope, you know what? I agree with Diane. I don't really need it. Let's stick to savings and we're good. So think of it that way. And of course, you can all, take a copy of your book and read myth number 4. That is our show for today. Please subscribe on iTunes or wherever you get your podcasts. And if you're watching on YouTube, because we do have a Debt Free in 30 YouTube channel, please hit the subscribe button so that you don't miss an episode. Thanks for listening and watching. Until next week, I'm Doug Hoyes. That was Debt Free in 30.